So we will start with the next standard of consolidation. Okay, then after this we will do Ind AS 28, and from there we will go to 103 and 110. Now what is this joint arrangement? Now who is controlling? Or it is jointly controlled? One person is fully controlling. Jointly controlled. Now see, you cannot, that's the problem. Today's day, what looks, no, it may not be what it is. That's why we see, once upon a time, 100 years back, life was simple. Crooks were there at that time also. But the innovative instruments, innovative legal provisions, all those things were not there at that time. Things were fairly simple. But today things have become so complicated, so you have to evaluate lot many things to see what it is, who is controlling. If it's driving school, both. How do you say both? On what basis you say both are controlling? Okay, now one well comes. That lady wants to drive and jump over that well. Is it possible? No. This guy wants her to take her or jump over the well. Is it possible? No. See, why? Because what is the most relevant activity here? Most relevant activity. That's what, Baba, that's what you need to understand now. In control, see, we are done, okay, with the old traditional 50% holding, 20% holding. No more. In control, we are going to talk about something new concept now. Beautiful concept. That means without holding 1% share, one share also, I can control someone. I have to prepare consolidated statement. This concept is never heard in accounting standard. Accounting standard looks for 50% there. Now tell me, what is the most relevant activity here in this driving? Movement? Movement, no. Can you teach driving without the car moving ahead? Movement is the most relevant activity. Now question comes, who is controlling the movement? Both. That means without a unanimous consent of both the parties, movement cannot happen. Then we say that yes, there is a joint control. Now if that movement has to happen, both the parties have to agree, otherwise other party can stop it. I say, I will not permit. How do you see? Let me see. No, not possible. The movement doesn't happen only. Followed now. Keeping this in mind, let us understand what is this joint control, how it works. Joint arrangement. See, you may get, we will discuss different terminologies now, and you have to be good at those terminology, students, because it may be a little bit confusing. Joint arrangement, joint operation, joint venture. Now what is a joint? We are going to discuss three things here under joint arrangement: joint arrangement, joint operation, and joint venture. Now what is joint arrangement? A joint arrangement is one in which two or more parties have got a joint control. What is control? Two or more parties jointly control the relevant activities. How? Through contractual arrangement. That means if somebody is sitting there to drive, there must be some contract. Simply, you cannot go and sit in somebody's car, no? Teach me. You must have entered into some contract. And the decision on that relevant activity requires unanimous consent. It is two things. There should have been one contractual arrangement to control the relevant activity, and both the parties should take unanimous consent there. Need unanimous consent. So how do you assess whether there is a joint control? First you need to check, is there any contractual arrangement? No, outside the Ind AS 111 scope. If yes, then you should see, are you taking unanimous consent? No, outside. Yes, it is a joint arrangement. That's it. Finish. We are done with the joint arrangement. Now why do we need this joint arrangement? Okay, like the joint arrangement will be classified for accounting purpose into two categories. It's called a joint operation and a joint venture. Because today's day, people are very creative. I will show you in India's 103. I will ask you, see, certain questions, no, you will not understand whether it is a lease as per 116, whether it is a joint operation as per 111, or it is a business combination as per 103. This type of question now new generation is going to face now in CA final. In MTP, I'll show you now. It is very difficult to distinguish. And first of all, why they have given right now? Because this is what exactly happening right now outside. And we should know that. Previously, it was not happening. When I was preparing that, fairly simple, Baba. One question, amalgamation, do, amalgamation, fill, tak, do. But today, no, I have to think, is it an amalgamation on 116 there? Did it acquire the acquiree? Or I have taken it on lease? That's why these things may look like a theory for you, but understand in depth what exactly it is. Now, joint operation means the rights to the assets and obligation for liabilities are owned by the joint. And here, joint venturers have got rights to the net assets. Now, what is this joint operation? That's it. My joint arrangement is done. We will not talk anything about joint arrangement from now onwards. Joint arrangement is only one. There's a contractual relationship to control the relevant activity and unanimous consent. Anybody asks you joint arrangement, tell this much, finish. What is joint operation? It is an arrangement whereby parties have rights to the assets, obligation to the liabilities relating to the arrangement. Like I will tell, tomorrow there is one temple function is there. I will bring gas cylinder. You bring potato twister. You bring that stall. We all three will put up and sell the twisters. Whatever money comes, we will do 1 by 3. Now, what type of arrangement it is? Is it an amalgamation? I can create one company, no, in the name of Potato Twister Private Limited. I can create that. Because to get an accounting effect, I can do that. Now, question is what type of arrangement it is? Is it a joint venture? Traditionally, you would have said it's a private limited you created. No, it's a joint venture. Now, question comes, once the temple function is over, what about that cylinder? You say, sir, who has bought that person will take. What about the twister machine? Who are bought? Then how come it is a joint venture, Baba? Because the parties have got rights to specific assets. They have got obligations for specific liabilities. This doesn't happen in a company. You have invested in MRPL. Tomorrow you say, sir, I have 10,000 rupees I have invested. No, I will come there and I will take one table. 10,000 rupees worth of table. They will not allow you to enter only there in that company. Why? Because you have got right to the net assets. You say wait up to liquidation. Then you come and take your net assets. You can't take the specific assets there. So those participants are called joint operators. Are you clear, students? Very clear, no? Okay. Generally, these are not structured through any legal entity, vehicle. Now, how to account joint operation? See, for joint operation, Ind AS 111 is going to account. See, joint op, if you decide, sir, this is the joint operation, which standard is going to tell? 111 is going to tell. It says that the joint operators shall recognize their interest in the joint operation. That means its asset along with the share of jointly held assets. Like I will take back my cylinder. Cylinder I will show in my financial statement. So whatever it's my cylinder, I will show in my cylinder. Along with that, we have put 5,000 rupees cash also. You will take your twister, somebody will take their structure. That 5,000 rupees cash, 15,000 rupees cash has got converted into 30,000 rupees cash. What is my share? 10,000. So it is my assets along with my share of jointly held asset. That 30,000 is a joint asset now. In that my share is 10,000. I will take it. My liability, because to take this cylinder, I have to keep one deposit there. It's my liability. Tomorrow, who has to pay that liability? If cylinder is lost, I have to pay. Will you pay? No. That's a contractual understanding. Including my share of liability. Like potatoes we purchased on credit. Who has to pay? Everyone has to pay. In that, how much I should pay? 1/3. Finish. Will I pay everything? That is joint arrangement. That is the operation. That's what the understanding is. And here decision is unanimous. Yes, no? Why? No. In why decision is unanimous here? See, we three are there. Now, just because it's the share? Simple, Baba. See, you say that if you don't listen to me, I will take my cylinder back. What you will do? If I don't listen to you, you will take your twister back. Will I fry the potato and give? No, somebody will take their asset. So it actually stops the option. And what is the relevant activity here? Relevant activity which earns revenue. That final product, that is a relevant activity. Now decision about that is controlled by three people here, unanimously. One person says no, veto, gone. This activity cannot continue only. Now, revenue, my share of revenue, expenses, my share of expenses, simple. Now, what are the points to remember in accounting? Accounting entries are recognized in the operator's standalone financial statement as if they were independently done by the operator. That means it is not a separate accounting. It's my cylinder. How I would account my cylinder in my financial statement? Tell me which standard I will apply. PP. So I'll continue to recognize it as a PP only, but only I will designate separately PP given for potato twister joint arrangement. But where do I record it? In my balance sheet only. I don't prepare a separate financial statement there. If an operator prepares CFS, they will automatically flow into the CFS. A joint operator shall account such assets and liabilities line by line basis as per applicable Indians. That means if I have taken a loan to buy this cylinder, how do I account the loan? As per 109. Same thing. When a joint operator enters into any transaction with the joint operation, in effect, I am actually transacting with other two parties. When I give anything to you, in fact, it is giving to two other parties. In that, my share I will deduct. Other two parties only I will recognize it. Suppose I have sold something at a profit. In that profit, I have got 1/3. No, I cannot recognize. I should recognize only 2/3 of the profits. If I have sold my asset to you, you said, no, sir, whatever cylinder you have, you don't bring into. Our joint cash is there. No, you sell it to us. So if that case, I have to recognize my share of profit only. Any gain or loss recognized to the extent of other parties' interest. Right for the assets specified in the contract may differ from the ownership interest in the joint operation. So contract may say 1/3, but in reality, I may be taking something different there. Then I should go into the substance because contract will tell anything. Accordingly, the joint operators need to recognize its interest based on the specified in the contract rather than the proportion of ownership interest in the joint venture. So, okay, ultimately what I need to recognize, what is told in the contract, because ultimately contract is enforceable there. So I need to consider, recognize my interest based on what is told in the contract. Now one question comes, in our three people, one more person joins. That person has given 5,000 rupees cash. He doesn't have any assets. Twister is everything we are wearing, no. Now he is our one of the friend. He also given 5,000 rupees because if income comes, he will be given some share. Now, does that person has got a joint control? No, not as net assets. In the relevant activity, does that person has got a joint control? No. Why? Yes, why? No, because he cannot stop the operation. No. Can he tell, no, don't prepare? I say, get lost. He say, give me cash back. Take your cash back. He cannot stop it. That means he is a party to the contract, but he doesn't have joint control there. That type of people may be there. Now, whether such a party has got a right to the assets and obligation for the liability in the joint operation. Now, question comes, okay, some party has a party to it. He has contributed some money. Now, is he having right to specific assets? If answer is yes, then he should account it as per joint operation only. If answer is no, you have to account as per Ind AS 28 or 109. That's it, finish. Now, we will do working as per this. We will solve problems. But before we solve problems, we will understand what is joint venture also. Yes, any doubts? Right, or assets and liabilities. And generally, no, we don't have any, it's just a contract. We don't establish any company, private company and all. It may be a partnership, may not be a partnership. That's what, no, if you say it's a partnership, it becomes a legal structure there. I don't create any legal structure. It's just an arrangement. That's why it's called a joint arrangement, joint operation. It's the operation, that's it. Like for example, simple. Your house is there, your neighbor's house is there. Now you need a compound hall. What do you do? You say half you pay, half I'll pay. Who is the owner of that compound? Both. Followed, no? Now, did you enter into a partnership company, partnership firm for that, for contribution? Nothing, no? It's just an understanding. Oh, you may have one legal doc paper. You may get signed and say, okay, one copy you keep, one copy I'll keep. So that tomorrow there should not be any dispute. This is my compound hall and all. Both are the owners. So that is a joint operation actually. Now to do that, I might bring my axe, he will bring his, he will incur some contract. He finally will do one final settlement. Okay, how much cost came? Okay, half is this, half is mine. That's called a joint operation. It's not a joint venture. So like this, see, to avoid all this thing, no, to avoid consolidation, people may do that. One of my asset, MRPL may sell one joint arrangement like this. Followed? No. So now this creates possibilities. See, that's why people understood it. Instead of creating a, what is it called? You create a partnership firm and all, it gets attracted. People will come to know. Rather than have one contract, no. Have an arrangement, no. Finish. Give your asset. Your asset is there in your balance sheet only, but it is operating somewhere else. So there was no standards to account this. It was outside your financial statement. Some operations are happening some far away. Like pipeline we are laying. Both the parties together. We say that morning in this pipeline, whatever water comes, I will take. Evening, whatever water comes, you take. Now, who is the owner of that pipeline? How that pipeline was constructed? How to account that? Is it a joint operation? Or is it a joint venture? Or is the lease? Can be lease, no? I may invest full money and I may permit you to take some water during evening. That's what, see, now you have to apply the principles of lease there. Identified asset, right over the specified term, no substitution right. If that fails, then I should see, okay, what is, am I have the right to any assets? Like this type of analysis is going to come, sure, no? And see, my guess, in upcoming days, no, FR is going to become very powerful thing. Why? Because they have removed your SCMP and law from final. Why? Because they want us to be more focused on our core, and our core is FR. That's why this type of analysis need to do. You need to get into it. Clear now, Vidya? Okay. Now, what is a joint venture? Now, it is an arrangement where the parties have got joint control, obviously. If they don't have joint control, then joint arrangement only doesn't happen. Then there is a question of joint venture, where rights to the net assets you have got. Net assets means the final what you get, no, in that 10%, not individual. Fan is yours, table is mine, not that type of arrangement. We will sell everything. What money we get out of this net is yours. If you want, I will sell fan to you only. But the sale consideration belongs to our company as a whole. Your share is only net. These parties are called joint venturers. Now, accounting for joint venture, okay, we are not going to talk here because the standard says you follow equity method of accounting. Now, equity method of accounting is meant for two things: associates, joint ventures. Joint operation, which standard? Operation 111. Joint arrangement, joint arrangement 111. But how to account joint arrangement? How to account a joint arrangement? My question. That's the answer. You should say joint arrangement accounting depends upon the classification, whether it is a joint operation or it is a joint venture. If it is a joint operation, it is accounted as per 111. If it is a joint venture, it is accounted as per Ind AS 28. Followed, no? Going forward, anybody interview also, if they ask you, they should tell. Now, how to distinguish between joint venture and operation? Because people are very smart there. First, determine whether the joint arrangement is structured or not. Have you created a partnership firm, private limited company, trust or something, or it's just an agreement? Example, if a separate vehicle includes a partnership, company, trust, etc. If it is not structured, straight away it is joint operation. That means you have got one legal stamp paper. On stamp paper, some understanding has been written. It is joint operation. But if it is structured, that means you have created one private company for this operation, like I told you, Protector Twister Private Limited, then entity should consider below to assess whether arrangement is still venture or operation. What is the legal form? Say partnership firm or a company, because in partnership, if it is a company, what happens in company? Company are eligible for net assets. But if you establish it as a partnership firm, in a partnership firm, you need not be eligible for net assets, no. You may be eligible for specific assets. You may be eligible for that. So that's why, just because you have established a partnership firm, it need not be a joint venture. I may still classify it as a joint operation. Depending upon, I have to go through now, contract. What does my partnership deed says? Whether the net settlement is going to happen or individual, the vehicle is yours, fan is yours, that type of settlement is going to happen. That I need to see. The terms of the contractual arrangement, like I may establish as a company only, but there is one separate contract permitted by articles of association, which is overriding. It says that in the event of liquidation, this particular asset should go to that particular person. Arre, Baba, it is a private company. How can you tell this asset will go to whom? It should go to all the net assets, net owners. Now, if you have got such contracts which will override the legal form, yes, it is, even though it is a private company or a public company, it is a joint operation. Now, or any other facts, like legal form. The legal form of the entity is a joint operation. If you get that it is a joint operation, then you need not evaluate further. See, people are more focused not to classify it as a joint venture. People want to avoid it because it will straight away come in the consolidation statement, consolidation and all. Okay. So we want to push, because if they don't want to hide it in the joint operation as a joint venture, we don't want to permit that. So if the legal form indicates it is a joint operation, you stop your evaluation. Otherwise, continue. Contractual terms alters the rights confirmed by the legal form. It is a joint operation. I told you, in the event of liquidation, or other facts to be assessed, like parties have got all the output of the separate entity, like you have established Potato Twister Limited. Chalo, very good. Now, who is enjoying the output? Can that entity sell the output to any customer at the standalone price? Or have you told that all the output you should give it to me only? It can be possible, no, Baba. Like, for example, this is Karnataka Bank Limited. This is Canara Bank Limited. They have set up one company called a Finacle Limited. Now, this company is going to give maintenance service for their core banking, Finacle core banking solution. Now, tell me, is this Finacle Limited is a joint operation or a joint venture? Question is clear? Or Nokia and Samsung has set up one Noksam Limited. Their job is to manufacture batteries, and all the batteries it should give 50% to them, 50% to them. Is this Noksam Limited is a joint operation or a joint venture? Okay, let us first evaluate. What is the legal form? Limited company. Limited company says that net assets. So this condition failed for operation. As per this condition, it is a joint venture. Is there any overriding contracts that in the event of liquidation, this particular battery manufacturing unit should go to Nokia Limited? No. This also failed. Now you have to see whether this Noksam Limited is independently giving service to other banks. Is this Finacle Limited giving not selling batteries to anyone else? Here, are they giving services to anybody else? No. Their entire output is consumed by two entities there who are parties to the contract. And the parties are the only substantial source of cash flow. That means this company has to entirely depend upon these two parties because they don't have any right to sell to third parties or take a bank loan. If they want a bank loan, they have to approach this Noksam Limited, Nokia or Samsung only. If Nokia or Samsung approves, both will approve, then only Noksam get the bank loan. Now, in such case, even though it may look like a joint venture, it should be treated as a joint operation. Because accounting is substantially different. Why? Because that's what no other factors says that joint operation, if they have given two conditions, parties have got right to all the output, and they are substantially only source of cash. Every output is coming to you only, no. Like I will tell you, okay, you bring your shovel, okay, I will bring that piercing thing, okay, we will make one hole and take gold from bank. And we will establish one company called Catch Me If You Can Limited. No, joint operation or joint venture? First of all, is it a joint arrangement? Yes. Why? See, I will bring shovel and you will bring that to take that sand. See, without our mutual cooperation, work cannot happen. And when we get the output, we share it between two parties. Just because you created one legal entity there, it doesn't change. So ultimately, it will be a joint operation only. After passing all these tests, if you find, yes, that joint operation is a very independent entity, then you say joint venture. No, if the decision, this Noksam Limited, if they could have taken independent decisions, if they could have sold to third parties, then this is a joint venture between Nokia and Samsung. Parties don't have any individual discussion there. Oh, this loan I will take, pay tomorrow I will pay. No. Both people have to pay this loan 50-50%. Not individual thing. That's why in every question, in AFM also, there is a joint venture. See, we don't go to that depth there in analyzing. Because accounting doesn't come into picture. Financial parts, from the financial perspective, you will ask, sir, what is the difference? What difference it makes? From a financial angle, it doesn't make any difference. But from an accounting angle, it makes a difference. Now, I'll show you how it makes a difference. Clear? Okay, so first you need to evaluate, is it a separate vehicle? No. Joint operation. Yes. What is the legal form? If fails, joint operation. Legal form pass. Is there any contracts? Yes. Joint operation. No. Any other factors like output, loan, substantial cash flow? Yes. Joint operation. No. Joint venture. If joint venture, Ind AS 28. Joint operation, it is Ind AS 111. Okay, students, so now let us understand how to do the accounting, a very different form of accounting which you may not have come across. Let us see now. So take out question number 36. See, this example, we will not solve it, okay, just understand, let us discuss it. because this is my own example to make you understand how a joint operation is going to work. So rather than noting down, because anyhow they are not going to ask this question in the exam, why you want to sit and note down? We will discuss it. Everything you need to understand it. Yeah, you can open the question number 1 so that you can refer it again, because I'll ask you so many questions in between. Now, balance sheet of J Limited and O Limited is given below on 31/3/2020. This is J Limited balance sheet, O Limited balance sheet. They have got land, building, investment, cash, share capital, other equity, non-current liabilities, bank balance. Now, other information on 1st of April 2020. This is when they have given, 30th March 2020 they have given. Okay, closing balance sheet is given. Now, on 1st, what happened? Both the parties started one joint operation called a JO. Chalo, no assessment required. They are also very clear. Straight away they started one operation and held the interest in the ratio of 60/40. But the decision is unanimous. Otherwise, we cannot call it joint. Then what it is? If the decision also in the ratio of 60/40, what it is? It is Ind AS 103, business combination. Consolidation has to be prepared now. If this is 60/40 in decision also, if it is 60/40, no, J will prepare 110, he will go Ind AS 28. Now, if it is a joint operation, both people will go for 111. Don't go with 60/40 there. 60/40 is a contractual sharing. That's what they said. In reality, the decision making may be unanimous there. Now, Ind AS, see, that's why if you acquire, if this operation is really something where J Limited will hold 60% of the capital plus controls it, then when this entity is established, no, you have to treat it as a subsidiary of JO Limited, becomes subsidiary of J Limited. And the first time when 1st April 2020 it started, no, you have to prepare 103 consolidation. At the end of the first year, 31st March 2021, J Limited has to prepare consolidation as per Ind AS 110. And O Limited, since it is a not subsidiary, no, for them it is subsidiary, for you it is influence only, significant influence, no, because you hold 40%. So you have to account it as per Ind AS 28. Not clear? You can ask me, please. I want you to discuss and clarify your doubts. See, first thing is, are you clear that if at all it is not a joint arrangement, that means both the parties' unanimous decision is not there. Question comes, who can control? Say J can control. Why? Because he is holding 60%. If J can control, obviously O cannot control. One among the two can control. If you say, sir, both are controlling, then I call it joint control. If J is going to control, what then O is going to do? He can only influence. So, if this is going to happen on 1st April, first time J Limited is going to prepare CFS as per Ind AS 103. O Limited is going to prepare CFS as per 28. But O Limited, CFS and SFS doesn't matter, it's same. Because something new item is going to come in J Limited called goodwill, which is subsumed in the value of the investment for O Limited. O Limited will never recognize separately. Yes, anyhow, as we proceed further, you will understand what I am trying to tell here. You will get very good clarity on that. Followed, no? Now comes 31st March 2021. 103 is only one time in their life. No more 103 again. It's only on 1st April. Now on 31st March, you are going to prepare again CFS with 110. But since you are going to hold the influence, you are going to prepare CFS now. You prepared CFS, but that is meaningless. Because that is also cost, your standalone is also cost. So nobody wants you to prepare because no goodwill comes into picture. Here goodwill comes into picture, that's why you have to prepare it mandatorily. At the end, you prepare as per Ind AS 28 equity method. You are 100% consolidation. Yes, Vidya, clear? Yeah. Sorry. In the standalone, they will apply Ind AS 27. Whatever investment they have made, no, it will treat as a 103 first time. And then subsequently 110. He has to prepare consolidation as per Ind AS 28 at the end because he is having influence. I told you in Ind AS 27 I showed 4 things: separate, economic entity, consolidation. That's why. It's an economic entity, because if they already have got a subsidiary, then it's part of the one scheme of us. But economic entity balance sheet, financial statements are also called consolidated financial. There's no much difference. There's only one item is going to be different, that's investment value. Otherwise, everything will be almost same. But when you talk about this 110 consolidation, no, it is totally different. You see that it is what you will ask what it is. Okay. No, that's what they said. They have made an assessment and they said it is a joint operation. That means even though it is 60-40, the decisions are unanimous. 111, both will follow, no, 111. Now, how that 111 will look like, that's why I have given this example. Search in YouTube, in entire world, and find one solution like this. Because this should give you, with this, no, let us understand the study material solutions. You will understand it very well. Otherwise, study material questions will look like alien to you. You wonder what they are doing. Now, what happened? Both the parties contributed cash of 5,000 rupees each. Understand? J Limited transferred land to JO at a fair value of 8,000. How much is the value of the land in their books? 10,000 rupees. They transferred at what value? Fair value of 8,000. A loan of rupees 10,000 at 10% interest was taken by JO. JO in their capacity only they took the loan. On 1st of April 2020, based on the guarantee given by J Limited. Okay, anyhow, J Limited is an off-balance sheet. It was agreed that J will take over 100% of the loan. This is called a right to specific assets, right to specific liability. During the year, now where this loan should get accounted? It will be accounted in the books of J Limited because he is going to take over that. During the year, what happened? JO started construction of a PP from 1st of April, and on 30th September the construction got completed. So you will, till from 1st to September, it was a capital work in progress. Now you will recognize as per Ind AS 16. The cost of the construction is 10,000 rupees, and the loan was taken specifically to construct the PP. That means that whatever interest you have been paid for 6 months, you should capitalize now. And the life is 10 years. That means you are going to capitalize it in depreciate for 10 years now. That means this year only 6 months depreciation is going to come. The loan is not yet repaid on 31st March 2021. Afterwards, it becomes a general interest. Whatever interest is there, that expense will go to P&L account now from 1st of October. Further, JO incurred some maintenance expenses, 1,000 rupees during the year. This will go to the P&L account of the JO P&L. Out of that P&L, there is 2 share, 40, because this is the joint expense. So when you recognize your expense and your share of joint expense. Since loan is yours, interest expense is yours. Since maintenance is ours, yours is only your share. Are you getting this? Now PP is whose? Ours. So you will take only your share of depreciation and your share of PP, because they didn't tell that PP belongs to so and so. At the end of the year, the newly constructed PP was purchased by J Limited from JO at 8,000 rupees, whose book value was 10,000 rupees. Oh, now my JO incurred a loss. That 10,000 rupees plus borrowing cost of 500 minus depreciation for 60 months, rupees 500. Okay, this is the book value, correct? No, 10,000 was the construction cost plus borrowing cost of 500 rupees you added, plus you have got charged depreciation of 500. Minus 500. No, 10,000 rupees plus borrowing cost of 500 minus depreciation of 500. So it was book value was 10,000 only. Book value is 10,000 only. Its fair value was 8,000. Now pass the journal entries and prepare the balance sheet of JO and J Limited. Not O Limited, they didn't ask. Only J Limited and JO as at 31st March 2021. Now there are two balance sheets. One, JO itself will prepare. Obviously, no. Otherwise, whose money, who comes to know? Then J is going to prepare. Now, how J is going to account this? Which standard? 111. Because it is a joint operation. And 111 says your share of assets you account as per your Ind AS. If it was a joint operation, you would have shown one single line item called investment in JO. And you would have accounted as per Ind AS 28. You would have taken, because JO would have prepared one P&L account. You would have taken your share of profit. That's it. Simple accounting. Very simple accounting. Now, the moment it becomes joint operation, you see. Okay, now tell me, students, what is my journal entries in the books of JO? Can you tell me on 1st of April 2020, what entry I should? You see, read this. Okay, cash account debit. Only cash. You get cash also. How much? JO 10,000. Land 8,000. To capital. I'll call it capital. For JO, it's the capital, right? Do they need a distinction there? If you want, okay, there will be some breakup. Yeah, I know. Because it is like you transacting with the other party. But JO is the joint operation, no? Then what happens? Obviously somewhere some accounting should be there. No, others who will come, like partnership. Will you not prepare partners A capital account, B capital account, like that? This is the example. I have not given that. Otherwise, you will generally make that bifurcation. Capital of A, capital of this. So you have got to know. Now J's capital is how much? O's capital is 5,000. 13,000 is the J's capital. Is there any more entries? Yes. What is the entry? What is the second entry? Cash to loan. For them it is loan. No, somebody has agreed to take over. That's a different story. Then on 30th September to cash. You have capitalized the PP on 30th September. Then on 31st March, then is there anything else? When you will pay? No. Okay. He will take over the loan. But when interest is paid? Interest is paid when? Right now or at the end? End. Who will pay? JO, no. It's a Baba. You have taken a loan. Why he has to pay the interest? You may pay it. Then it becomes a capital. Whose interest expense it is? JO. Then so if you don't pay, you say interest expense account debit to capital. If you pay, you say interest expense account debit to cash. No, borrowing cost is not excluded. That's what I showed you, no, at the last. I showed you one calculation. No? So for time being, it is excluded. It's not part of the thing. So at the end of the year, you will pass interest expense account debit. How much? Only 50%. PP account debit. This is capitalization. Taken together, 1,000 is the interest cost for the year. It is a 10,000 rupees loan. 10% is the interest. After PP, we will not capitalize. This is in who is telling you? Which Ind AS 23, which we are yet to do. That will tell you. You learn it better, you grasp it like this. We added, no? See. If you want, okay, you pass this entry on that day only. Interest expense, PP account debit to outstanding interest expense. Outstanding interest expense debit to cash. That is left to you. I am just giving one simple example. You understand how this works, huh? Because you get a different perspective if you understand this. To cash. Is there anything more? Huh? Before that, depreciation. So you will pass one entry, depreciation account debit to PP, only for 6 months. Now you will transfer. Okay, are you clear now? Now you transfer the PP to J. What entry you will pass? J limited account debit, loss on sale of PP to PP, because you have transferred at 8,000. Correct? You can assume it. That's then yeah, he will consider he has paid more cash now, more capital he has paid. That all goes with the what actually happens. This is one simple example I have given. Okay, to look the effect. See, this is simple, Baba. This is, I can say, what is that? First year PUC or second year PUC entry. There is no difference here. Anybody will not find. Now, my point, why I am giving this example, just to show you how it will appear in J's book, which you have not seen till now. Then, what is my cash balance at the end? Okay, look at here. Again, it's a simple question now. You had got cash of 10,000 at the beginning. You got the loan. You spent for PP. You spent 1,000 maintenance. Interest cost 4,000. 1,000. So 8,000 left, where 60% belongs to you, 40% belongs to him. Because cash is a common asset. No? Is cash somebody's asset there? No, cash is a common asset. So 60-40 they are going to share it. That is the arrangement now, Baba. They will earn now with this PP, they will earn no. And why this PP is sold at a loss? See, both the J and O are intelligent people there. Don't think that one is the fool there. They have made some arrangement there. So somebody contributed here, asset is created, asset was sold at a loss. Now that O also knows. That's why O is compensated with more cash there. No, it is paid by cash. JO, no. I see the entry here. See, 2 cash try. If you say J, then I will say J. No problem. Doesn't matter. I have to account it the way that it happened. In this time, cash balance will be more. That's it. So don't go more deeper. Why? Because this type of questions are not going to come to you. I'm just telling you how it looks like. Then other equity balance, you charge depreciation, which will reduce your P&L. Maintenance cost is going to reduce your P&L. Interest cost is reducing P&L. Loss is going to. So in fact, you didn't earn any revenue only. You have accumulated loss of 4,000 rupees, which has got 60-40 share. Now, if I have to prepare the balance sheet of JO, how it looks like? Land 8,000 rupees, because land is not yet sold. When this is going to close, then he will take. Current assets, financial assets, receivables, how much? J has to pay me 8,000 rupees. It's a financial asset now, contractual right to receive cash. Cash of 8,000 rupees I have got. My asset is 24,000. On the liability side, equity share capital is 18, other equity is 4,000, negative loss. Loan is 10,000, so my total equity is 24. Finish. Sorry? No, that is now. Now comes. Now, second part of the question, they asked you, what is my in the books of J? Actually, I should not have given, but at least you understand, no, when a joint arrangement happens, how the joint arrangement is going to account it. Simple, first PUC accounting, no headache only. If you want to give the breakup, capital of so A, J, capital of O. Now you have to tell me, yeah, now let us discuss. In the books of J, on 1st of April 2020, they contributed something. What entry they are going? They gave cash. How much? 2 cash, 5,000. See, for not investment in JO, because for them JO doesn't exist. It is my PP only. It's my. I am going to show in my books only, Baba. Because they must have created JO limited, but it is not limited. It is operation. It's not a joint venture. If it was a joint venture, I would have straight away said cash, joint venture investment to cash. Then that investment I would have taken to Ind AS 28 and accounted it at cost or whatever. Today, since it is a joint operation, that what I make investment, no, it doesn't have a separate existence as such. It is my cash only with the other party. For me, JO is nothing but O. For me, JO is nothing but O only. I am dealing with O now. There's nothing called JO for me. It's O. Now, when I gave the cash, whom I gave this cash? I gave the cash to O. He also gave some cash. Okay. Then, how much cash I got? On day one, how much cash I paid? 5,000. How much he paid? Is that cash a joint asset or a specific asset? Okay, at the end, who will take the cash? Joint asset. At the end, who will take the cash? We will share. So, in that opening balance of 10,000, what is my share? 6,000. So, I will say, see, I paid cash, I got JO cash. You will wonder, sir, what is this? This is what it is. My cash is 6,000 now. Why? The moment this arrangement is entered, I will get now 1,000 rupees extra from him because he only agreed. No, okay. Will you enter into a contract with me like this? We will both pay 5,000, and my share is 60,000 in that. No. Why? The moment you sign the contract, I say net settlement, give me 1,000. You incurred on day one only. Now, why you do it? You must be having some intention. Somewhere the adjustment must be happening somewhere else. Followed, no? So, to what? O Limited. Now, how did I get this 1,000 extra? O gave me. For capital and all not there, because this is in my financial statement. It's not an investment. If it was an investment, if you would have classified JO as a joint venture, can you tell me what is my journal entry? Investment account debit to cash. How much? 5,000. Finish. If it was a joint venture, investment to cash. Done. Since it is not a joint venture, I should pass one accounting entry like this, which looks strange, but that is the truth. That's what the standard says. Transactions in a joint operation is effectively considered as a transaction with the other part. Are you clear about this journal entry? Now, you sold one land also. Okay. So, J Limited should, and you sold at a loss. Can you say, I have sold to myself? No. So, you cannot. You have to recognize the loss only to the extent of other parties' interest in the joint operation. Now, what is your entry for sale of land? One minute. So, you will say to land. Land goes out, no? How much it goes out? Are Baba, in 10,000, 60,000 is your 60% is your share, no? So, it is 10,000 into 40. What goes out is only other party's share. So, 4,000 goes out. You made a loss. How much? Out of that, how much is loss to the extent of other party? That you recognize. Loss on sale of land. How much is 2,000 is the total loss? No. Out of this, 40% is the actual loss you incurred. Because what you gave, see, it's like I gave one asset to one company, means to you. In that, I have got 60% share. So, if I have sold at loss of 2,000 rupees, since I am going to get my share back, I cannot say, no, my loss is 2,000. My loss is what in reality I gave to you, that is my loss. So, my accounting entry will be O Limited account debit, loss on sale of land account debit, to land 4,000. Not 8,000 it was showed. It was a loss. That's why I will pass one more entry, JO land account debit to land. So from my book, entire land goes out. Land worth 6,000 I will retain, my share. Why? Yeah, correct, exactly. That's why I recognize loss to the extent of other party, no. What is value in my books? 10,000. Out of that, will I recognize loss to myself? No. How much is my share? 60,000. No? That's why I will keep in my books JO land 10,000. It's a separate distinction. When somebody looks into JO land, they understand, oh, this is your land given to that operation. It's like cylinders I have got, 5 cylinders. I will mark one cylinder, twister cylinder. That means this cylinder is given for twister operation. So that I can account it. I will know, no, tomorrow 5, this thing, what is that called? Omelette cylinder has come back to me. Your, what is that called? Burger cylinder has come back to me. 4 cylinders have come. Which cylinder has not come? How to know now? That's why I mark it. Twister cylinder. Oh, twister cylinder didn't come. No, I'll immediately call that operation. Baba, operation finished. Where is my cylinder? So that's why I give a different nomenclature to identify in my books. Finally, these nomenclature will not come there. These are all ledger accounts. Have you understood this? Strange entry. Strange, no? This is what, Papa? That's you tell management. You want simple life, no? Tell them, no, create joint venture. Why you want into this type of operation there? You are asset, I will asset. Have you ever seen in your clients? No. That's why strange things, Papa. That's why people who do this, now they don't have any incentive as such. I will bring out very clearly. See, I will not allow you to recognize your loss. Previously, you used to sell to joint venture and recognize the loss and all. Now do it, that's fine. Because legally, if you sell to a joint venture, it is your loss now. Because joint venture is a separate legal entity. But in the name of joint venture, previously you were booking loss, which in reality was not your loss. Because you had a control over that asset. It was asset for you only, coming back to you only. Followed, no? So, I will not recognize loss to my share. I will recognize loss to the extent of other person. Now, you got one loan. What entry you will pass? So, you, okay, sorry? Okay, tell me, see, now you got a loan, no. Now, who got the loan? JO got a loan. Then? Okay, you tell me, JO loan account to loan. Who, how much? Who is supposed to take this loan? J. That means this should come in my balance sheet as one loan. So I will say to JO loan. That means it's my loan taken for JO's sake. How much? 10,000. Did I get that debit what? Bank. How much bank I got? Which bank? JO bank. No. Did I get the cash? Who got the cash? JO got the cash. So I will pass the entry JO cash account debit 6,000. Because when JO got 10,000 rupees cash, my share was 6,000 rupees in that. Another 6,000 that O Limited took. Baba, loan is on my head there. This entire loan is on my head. When I took a loan, only 6,000 rupees is my share. Other person share, understood now why he gave you 1,000 extra there? Because now he is taking 4,000 extra from you. That's why don't get into that numbers. Why? Because that's the financial arrangement. First in AFM it is going to, discussion is going to happen. Then the documents will come to you for accounting. Now you understood the substance, no? What exactly is happening? Which otherwise this entry would not have come into your books if it was a joint venture. Don't worry, this is only for your academic interest, because otherwise next you will ask me now, sir, what they are doing. I'm just telling you for your academic understanding how it works. Now on 30th June, what entry? 30th September. PP. Will you pass any entry? Your share of PP you should pass, no? So what entry you will pass? JO PP to JO cash. Because who paid? JO paid. But out of that, how much your share? Because cash is a joint asset, no? Every entry, whatever that JO passes, you have to, if that is, you have done it, like if that JO has done and your share is in that net asset, you have to recognize your proportion. Who paid? Who paid for this JE? In the first previous entry, if I go back, did they pass the journal entry for payment of, when they got the loan, they got the money, and the PP cost they only paid? No. Did you pay it? If you would have paid it, then what would have happened? For this PP, if you would have paid it, 10,000. 6th, 2 cash how much? Full 10,000, not JO cash. You paid, no? Exactly. You will debit O now. Because you paid cash 10,000, but that much worth of asset didn't come to you. Somebody else is taking share in that. Now you understood the logic? How this works? Interesting, no? Then you understand me now. I'm telling no, you just search in YouTube, say, get one example for this, one video. Just one video. Who has explained this concept? Just one. And without explaining this, how do you understand now next set of journal entries, what institute is telling? For me, I was not understanding only what they are trying to tell here. This is the logic of those entries. Next comes 31st March. What happens now? First is interest cost. What entry will pass? Complicated, no? Okay. First of all, JOPP, you capitalized how much? 500 rupees you, sorry. Hello? Yes. 500 rupees you capitalized. Will you pass entry? Obviously, because you got share, no PP. How much? 500 rupees, 60% you got share. Then interest cost they incurred, JO. Out of their interest cost, 60% is your P&L. And JO paid 600 rupees cash. In reality, they paid 1000 rupees cash. Out of 1000 rupees, balance 400, they O Limited will pass entry like this. Because the balance sheet of JO is just for the sake of one control then. In reality, it doesn't have any existence. Why? Because there is no legal structure, no. That's why we call it joint operation. Now you have got depreciation. As a company, even though you accounted as a company, in substance, it is not a venture. Because it has passed through the test, I showed, no. So those tests fail means you have to account it like this. If it fails. If it passes, then all this set of entries you will not pass. All this, whatever they pass, no, you take your share. Which one? P&L at the end of the year. Only that's it. Only P&L at the end of the year. Life is very simple now, Baba. And the profit or loss, they will prepare P&L. Their P&L's final net share, 60% you will pass one single entry. Your entry will be investment account debit to share of profit. As per Ind AS 28. Then please suggest management don't get into this type of arrangement because it is going to create nightmare for the accountant. And if you don't do this, auditor is going to sit on your neck, catch your neck there. Previously, this was not there. So it was a bottleneck for an auditor. Today, our profession has become very powerful with these tools. You can't simply play with us. Agree, no? Can you play? No. How do you do? I'm going to qualify it if you don't account it like this. Now, the moment you account it, no, it is going to create a confusion. Investors will not be able to understand. Then go and explain to the investors what you did. What I am doing is, what is the substance here? Okay, you took your share of depreciation. Now, purchase of PP happens now. J Limited should record the asset. How much now? How much purchase happens? there is 10,000 rupees worth was given for 8,000 rupees, right? Out of that, in how much is the total loss? 2,000. Out of that, how much is your share? 1,200 is your share, no? So first you pass PPE account debit 10,000 into 40%, 20% loss of O Limited. And you account PPE 10,000 into 6,000 to JO PPE. See now, you got PPE. How much PPE you got? So full 8,000 you have to record? No. You keep, no. See, no, Baba. See, 8,000 is the fair value. What is the book value? 10,000 is the book value. Arey Baba, it is your asset only, no? Out of this 10,000, what is the difference there? 2,000 is a loss. In loss, there are two parties. How much? 60%, 1,200 and 800. Now, can you tell me, will you tell me, sir, there is one 10,000 rupees asset of mine. I only took it at 8,000 rupees and I incurred a loss. And you are crying there. Who is on the earth who is going to listen to you? It is my bottle at 10,000 rupees. I purchased it at 8,000 rupees and I am crying, oh, I made a loss. You are laughing, no? Like the people will laugh at me if I tell that I made a loss. So, in reality, how much loss I made? Only 800, exactly. So, from I got a PP, how much? 3,200 net of loss of other party plus my share without any loss. The same thing what I did on day one there when I sold. When I sold, I recognized loss only to the extent of other party. Or I will recognize the profit only to the extent of other party. When I buy, I will recognize the loss or profit only to the extent of other party. My own party, my own asset, Baba. I will, when I take it, my share, I will not recognize any profit or loss there. So, PP in my balance sheet, it will be 9,200. To my share of joint PP is 6,000. Because if you look into, I'll show you at the final. You might have got fully confused now. Let us see how it finally it looks like. And 3,200 is the same. Is there anything more? Maintenance cost is there. I have to take my share, no? So JO maintenance cost account debit to JO cash. Now how much is my JO cash balance? Is my cash lying there? Previous working, 1 minute. Total JO cash balance came to 8,000. Followed? Previous JO cash balance, you remember that number? 8,000. First we did one calculation. Out of that, how much should be my cash balance? 4,000. Let us cross verify. See, share capital 6,000. I got JO cash, no. I paid 5,000, I got 6,000. So my JO cash is 6,000 plus share of loan is 6,000 plus share of PP, what I paid, first interest cost and maintenance cost. This is accounting, which is nothing but 8,000 what in reality there was a cash balance. Its 60% gives me this. You see, none of the entries will be here and there. Now, if I have to prepare other equity, same. So opening balance 7,000, loss on building, I have recognized only 800, interest cost, my interest cost, JO balance, JO maintenance. So other equity balance is 5,000. This is my opening balance in my balance sheet, my balance sheet value. Now if I prepare, okay, O Limited account, because he is a debtor to me now. O Limited is like debtor, no, my contract. I got a credit from him for 1,000 rupees. Then for sale of land, I debited him. I have debited him for taking a loan because I took the loan. Papa, he is taking share. How it is possible? I will debit him. And when I purchase this PP, he will keep quiet. He will also shout, no, sir, this is the JO. So you gave, so his closing debit balance is a debtor to me by 3,000. He has to pay me 3,000 rupees by the end of the year. And if I'm going to prepare the balance sheet, see, land. Do I have a land? 10,000 was there. Now, this I transfer to them. In that, what is my share? 6,000. PP 9,200. Because PP was never there in my books. They manufactured it. I took it over. But when I took it over, I will take it cost only because joint operation doesn't have any legal existence there. Building as existing 3,000 only. 3,000, no? Let us forget depreciation and all for time being. Otherwise, the building should be net of depreciation. Investment 3,000. Receivable. Oh, because he was not there, because all these adjustment resulted into he had to pay me now. Cash. 1 minute. Yeah, 6,000 minus 5,000 I contributed initially. Opening balance was 6,000. Out of that 5,000 I contributed. But I have got a JO cash of 4,800. That means my cash is lying in one different site there. 30,000 is my asset balance. Then I'll go to the liability. Equity share capital is 10,000. Other equity has become 5,000 now. Why? Opening 7,000 plus all other adjustments came because of the joint operation. Liability, I got my share of JO bank loan 10,000. It's my loan. I have to pay that. Tomorrow I have to show the obligation. Equity is clear? Enjoyed? Yeah, this gives you more empowerment. Don't worry, this is only for our understanding, academic understanding. Because otherwise, no, this type of questions are going to come to you as we proceed to the ICA questions, because ICA has not explained these things like this. Yes, so take out now from question number 2, we will work together and you have to tell me now. Simple questions, okay? From now onwards, it's simple question. Again, you need not go back what we discussed just now. P and Q form a joint arrangement using a separate vehicle. Oh, it is arrangement, not operation. Arrangement has to be classified into operation or venture. Now, P and Q owns 50% each of PQ. However, the contractual terms states that the P has got a right to all the machinery, obligation to pay all the loan. P and Q have got all other assets and obligations in their 50-50 each. This term results into what? Operation. Why? Because you see, if it is a PQ is a joint venture, this type of contract should not be there. No, machinery you will take. What is the meaning of that? Net assets. If this term was not there, you could have treated this as a joint venture. But they said no, all the machinery and that particular loan he will take. How they can say that? So this contract resulted into a joint operation. So PQ's balance sheet is given, like JO's balance sheet. This is my machinery, cash, capital, so and so, so and so. How should P record its rights and obligations in PQ? How much? On all? Machinery is 100%. Cash how much? Cash is 50%. Bank loan 100%. 50%. 50%. Your capital is only 50 here. Your control. That's it. Because even though it is a separate vehicle, there was one condition, that 3 condition, legal form you have to verify, contractual, anything overrides. This condition fails. Followed, no? But they didn't ask you the explanation, theoretical explanation. Otherwise, you should have written theory that it looks like a joint vehicle venture, but we have to make an assessment. As per that assessment, the second condition fails because there was a contractual term which overrides and it will give specific assets to specific parties, which generally do not happen. Okay, right, solution. As per Ind AS 111, P should record its share of asset and liability as below. Machinery 100%. See, students, after that first example, now you understand what I am trying to tell here. Otherwise, for me, it was like what to explain to the students. If you really don't understand what is this P limited is going to account, 100%, where, how? Now I can easily say, oh, I am going to account 2,50,000. In fact, it is JO machine. We will not write JO and all, that's for our understanding. And cash to the extent of 50%, 25,000. Capital will be 75,000, bank loan will be 100%, other loan will be 50,000. That's it, done. Yes, students, you can pause the video and copy this. Yeah, see, because once you understand consolidation is means tricky, easy, okay, but I am not saying anything complex. Everything is simple only once you understand it. But you have to clearly understand the interconnection, links. That gives you a lot of empowerment. Once you understand it, it's enough. Like, see, financial instrument, the moment I talk something, FEOC, FER, see, today you are in a position to ask me questions. So that it is told like this, it is working like that. See, that is an empowerment. Did you understand in detail how? Then left to you, Baba, you have to practice it. That is different story. But first thing is that understanding should sit properly, no? That's why during this time when I discuss, you have to pay your attention because you don't have any choice. It's an opportunity to sit here, to ask questions, to discuss. Correct, no? Because once it is gone, gone. Then comes your choice. Again, sit and practice. You see, miracles are going to happen. Nobody is going to stop you. This is my conviction, very strong conviction. Yes. Next question, which is an important question, but is it a test your knowledge question? New syllabus, no? Okay, very nice question, beautiful question. Probably they may ask you. On 1st April 2017, Alpha Limited commenced a joint construction of the property with the Gamma Limited. Okay, one property they started to construct. For this purpose, an agreement was entered that provide for joint operation and ownership. Which joint operation is maintenance, running, that operation, joint operation, not this Ind AS 111 joint operation. Don't get confused. Operation and maintenance, that who has to operate, who has to come and switch on the lights, that operation and maintenance followed, no, of the property. All the ongoing expenditure comprising maintenance plus borrowing cost is to be shared equally. Oh, that means their ratio must be 50-50. The construction was completed on 30th September 2017 and utilization of the property started from 1st of irrelevant for me. When it is completed, yes, PP 16 says that, Ind AS 16, start depreciation from here, at which time the estimated useful life of the same to be estimated 20 years. The total cost of the construction of the property was 40 crores. Besides internal accruals, the cost of the partly funded by a loan of 10 crores. This is a specific borrowing cost. And when you took this loan on 1st of January 2017, when you started to construct, 1st April 2017. So anything before construction period, P&L. Anything after you complete construction, P&L. What you have incurred, because this is a specific loan. There can be two types of loan, general loan, specific loan, you have done at the inter-level. If it is a general loan, then the amount of expenditure into capitalization rate. If it is specific loan, the actual cost incurred irrespective of whatever invoices you have paid. This, the period from 1st April to 30th September, you are going to capitalize. The loan carries interest rate of 10%. At the end of 30th December year, you have to pay. The company spent 4 lakh rupees on the maintenance of the property. The company has recorded entire amount of paid as investment. How much you paid? Investment in the joint venture in the books of accounts. Now suggest the suitable accounting treatment for the above transaction as per applicable Ind AS. Yes, is that correct what they did? Is that correct? Can they treat it as a joint? Is it a joint operation or it is a joint venture? Huh? It's venture. On what basis you say? Sorry? Question is very silent no here. Question is very silent. Exactly we don't know. But in examination, they may give you certain more inputs there. That at the end the asset will be taken over by A. Joint operation. Otherwise you can treat it as like a joint venture. If the question is very silent. But here somewhere we should say that the all-going expenditure and comprising maintenance. We can say from, if since question is very silent here, we can take this particular sentence as a base. Generally you should say this should be in the ratio of 50-50. Have you come across anywhere sentences like expenditure and maintenance plus borrowing cost to be shared equally? Generally that type of arrangement doesn't happen, no. And then question is very silent. What about the property? How they are going to share it? You assumed it 50-50. That means it must be a joint operation, not a venture. And if it was a venture, then why they will ask you 6 mark or 8 mark question? So be careful with this question in the exam. That's why you have to mark this important. One day before you have to see, understand what I am trying to tell here. The question is incomplete, and I will tell you my observation that the questions which are incomplete will be complete in the examination, which I am not telling you, I have shown you so many times. The confusion in the study material question is clarified in the examination. Clean question in the study material is made confusion in the examination. So you should be happy looking at this. Generally we feel discomfort, correct? No, you should get comfortable. I am telling you, even the worst case, they give you the same thing. I told you one strategy. What? Dump what you have studied, just dump that. Last, not first. Okay, so let us start the solution. As per 111, Ind AS 111, this is joint arrangement due to joint control of parties. I am giving simple language because they say suggest accounting. So some theory we have to write. We say that this is a joint arrangement. Since parties have rights to assets and obligation for liability, this is classified as joint operation. Are you clear? Now where this sentence is told, right now you don't ask me. In the exam you may get this sentence. It looks like joint venture, but that's what I'm telling. That sentence is missing. If then joint venture, then why institute has to solve this like a joint operation? Tell me. If you open the study material solution, I given the reference also, no? Study material reference. Just open the solution and see why they have to solve it. That means question is silent. In the exam, they will give you clarity. In the exam, if the question is silent, you can give such assumptions. Alternately, you could have solved like this also. You can do it like that if time permits you. Okay, but high possibility, 99% possibility in examination also it will come as a joint operation only, not joint venture. Understand, Baba? See, you should also don't expect too much from you. That's very clear. At least I could feel that what they are expecting. I have understood over a period of 6 years what they are, who are they. Followed, no? So don't expect that really if they want to complicate, why they? I can complicate. Add 4 elements there, it looks complicated. You spend 2 hours. Anybody can complicate, no? Adding more elements is complications. So don't expect that. Okay, is clear? Okay, now one more theory. Okay, don't need to write this, you can just leave it. Means when you practice, you write. Ind AS 111 state that if it is a joint operation, then you have to record its assets along with joint assets, its liability, joint liability, its revenue, joint revenue, its expense, joint expense. You can, if you want, you can leave some space. Now, you understood the flow here. First of all, we said that this is joint arrangement. Why? Because both the parties are going to control. In joint arrangement, this is a joint operation. Why? Because parties have got specific rights to the assets. And if it is a joint operation, it will be accounted like this. You will take your share. That's it. You are not concerned with the other party's share. Now to account, I need certain workings now. How much money is spent on PP? 40 crore. Will I recognize 40 crore? No, I have to recognize my share when end of the year. No. So I need certain balances. So right after this theory, you can just leave some space, okay, if you want. Anyhow, when practicing your where they have told. That's what, nowhere they have told. In exam, they may tell you. That's what I'm trying to tell. In the question is very silent. I agree with you. And in fact, they have told separate vehicle, all the story. But we have seen our assessment. No, our assessment, we will give importance to operations. Balancing figure is the venture. Okay, write first working note 1. Cost of PPE. Can you tell me, students, what is my cost? What I should start with? Total cost. How much? 40 what? Crore. Add borrowing cost. How much? Into 10% into is 6 by 12 is Vishnupriya, Vidya, clear, no? Getting the flow. Yes, so you are going to take 50 lakhs. So 40 crore, 50 lakhs is the total cost of the PP. Because you started from April, no? Even though you have taken loan from the beginning, you started from April. And after September, that will be a part of P&L. Now, what is your share? Alpha will recognize rupees 20 crore 25 lakhs, which is 50% of 40.5 crore as its share of PP. We will call it JOPP. So that there is one separate understanding. This is my PP, but physically available at some other location, geolocation.
So in this, if the construction was started that day when the loan was taken,
but your if the construction started, then you should capitalize for 9 months. No. Construction started from 1st January. But when joint operation started? 1st April. Okay, that means joint operation also should have started 1st January. Then by 31st March, there would have been capital work in progress. You will do full 9 months. Capitalization will happen for 9 months, but already you would have capitalized up to in the last year, 3 months. This year only 6 months capitalization is going to happen. Yes, good, nice. Previous 3 months, Jan to March, that will go to P&L account now. Now, whose P&L account it will go? Whoever has taken the loan. Have they told you here? It might have happened that one person has taken a loan there completely. He was paying. That cash balance was lying there. Then they came into joint operation. So maybe alpha was paying and it was going to my P&L account up to 31st March. 1st April we entered, no, we wanted a cash. Already my loan was there. I brought the cash also, I brought the loan also. And I told I will take 50% of the asset. Entire loan I will take care. See, anything might happen, no. And you tell me, I will record it. Simple. If you talk about, see, in whose books they asked you? P. Now we are doing in whose books? P. Or are we doing in PQ? We are doing in the books of joint operator, no. So I need to see how much is recorded there. It's how much is my share. That's it. This is what JO will record. I will record only my 50% share of. No interest should be capitalized because see, okay, for this you should have completed Ind AS 23 because Ind AS 23 says that capitalization can start only after the qualifying assets construction begins. Till that time you might have incurred, you might have taken loan from 1st January. That interest will go to P&L account. 1st April. 1st April to 30th September we will charge. Clear, no? Second, we will go to the depreciation charge because this year depreciation also has come. How much is my depreciation? Total depreciation 40 crore 50 lakhs into divided by 20 years into 6 by 12 gives you how much? 1 crore 1 lakh 25,000. Correct, right? Total depreciation for the year in the books of joint operation is 1 crore 25 JO. How much you will recognize? 50%. So alpha and gamma in their respective P&L will say JO depreciation 50 lakh 62,500. In fact, we could have mixed this with the next expense. Anyhow, we'll keep it separate. Is there any other thing you incur? Other expenses? Okay, we'll go to the other maintenance. What is my total other cost? Working note number 3. Because this will go under a depreciation cost. Correct? Is there any other cost? Yes, students, you can pause the video and complete this. So right next, the heading is other cost, maintenance. How much is my maintenance? 4 lakh. And then, done? But is there any other cost? Depreciation, interest. We have got interest cost. No, after the asset is constructed also we have got interest cost. How much is my interest cost? 10 crore into 10% into 6 by 12. Remaining September to March, which will go to the P&L account, not the PPE. 50 lakhs. Which one? This is a post-construction, post-construction cost. Because if up to construction you would have capitalized it and that would have been part of your PPE. Now you say that 50% of this will be included in the P&L account. And how do you classify? The interest cost will go as a finance cost and balance will go as a maintenance cost. Yes, students, you can pause the video and complete this. Yes, students, now tell me, is there anything left? Have you considered all the assets? Yes. Asset only one, no, what are all other assets? Have you considered all the income? You said there is no income only. Have you considered all the expenses? Yes. Have you considered all the liabilities? Then will you not account whose loan, whose baby it is? Our baby, no. I should record my share, no. Other, will you leave it? If you leave it, 2 marks you are going to simply lose. See, when you talk about a joint operation, every single asset and a liability, that's what that theory. My assets, my share of assets. My liability, my share of liability. My revenue, my share of revenue. My expense, my share of expense. So you have to consider these 4 elements. Have you recorded everything there? Most probably this question may come as it is. But don't miss that. So last one is the loan. How much is my loan? 10 crore. Is there any addition or deletions are going to happen? Is this loan repaid? What is payable? Interest is payable, not, they didn't say loan is payable, no. So should I add anything or is it done? My share I should take 50. What is included? Interest. What about the loan? I should take my share of loan, no? JO loan. How much? You're not thinking, Baba. Okay, 50% of what? That's okay. I agree with you. 50. Which interest is payable? Which interest payable? From Jan. Have you paid from Jan to March there? You paid from Jan to December. 1 quarter of previous year, 9 quarters, 9 months of this year. Have you paid balance? See, when you recognize expense 6 months from September to March, out of September to March, did you pay from Jan to March? Didn't pay, no? So is it not going to increase your loan balance? Then add outstanding interest from Jan to March. How much? 10 crore into 10% into 3 by 12. Understood, no? 25 lakhs. Nice question. Beautiful question. So it comes to 10 crore 25 lakhs and you will take 5 crore 12 lakh 50,000 as your share and recognize it. And underlying entries I have shown you. In fact, my example was based on these things only. That's it, done, finish. This is the way we are going to account it. Clear? Easy, right? The standard is simple, Baba, nothing. Not different, difficult. Just we'll finish now within no time. Yes, so we will move on to the next question. AB and BC have established a joint arrangement through a separate vehicle called a PQR. Oh, sounds like the previous question. The legal form of the vehicle does not confer separation between parties and separate vehicle itself. What do you mean by this language? Control, the moment they said they established a joint arrangement, it is understood that there is a joint control. What is the second part? And they established a separate vehicle also. Separate vehicle does not confer separation of between the parties and the vehicle itself. Both are same. It's like a partnership firm. Even though established a separate vehicle called a partnership firm, that and your vehicle and your partners are not different. That means what it is? No, even though you are created for namesake, that means your legal entity itself will fail there. The legal form is not sustainable to tell that it is a joint venture. So it's a joint operation. Thus, both the parties have got the rights to the assets and obligations for liabilities of PQR. This sentence may come in your previous examination, previous question in the exam. Then you get a better clarity. Oh, this is, and the previous question is very silent. As neither the contractual term nor the other facts indicate otherwise, it is concluded that the arrangement is an operation and not a venture. See how important theory. Now, both the parties own 50% of the equity interest on PQR. However, the contractual term of the arrangement state that all the rights to the building number 1 will be PQR, obligation to pay the debt owned by PQR to a lender XYZ. That means he will take building number 1 and the debt. BC Limited have all the rights for the assets of the PQR and obligation for the liabilities in proportion of 50%. Like this guy, AB will have specific asset and liability plus their 50% share, but BC will not have any specific assets and liability, joint assets 50%. Now they have given you PQR's balance sheet, JO's balance sheet. How should AB record their financial statement, rights and obligations in PQR? So what you need to do, you have to give me an extract of the balance sheet. In the exam, they may ask you extract of the AB's balance sheet, where in that extract, you have to show these components, how it will come. Sorry, AB's balance sheet, you have to give me extract. So some theory is there, okay, same last time we written, no? You can just leave some space to write it later. That this is a joint operation, we have to account it as per individual my share of assets, my share of liability. So please pause the video, students, and prepare AB's balance sheet with an extract of these components. Question is clear, Vidya? In the first question, we have done that, but it was not an extract, it was a statement. Machinery, cash. It was not an extract, it's just a statement. Extract means it should come in Schedule 3 format. Assets, non-current assets, PP. Understood? No. Under PP, building 1, building 2. That format we need. So we'll compare the answers. First thing, this is a joint operation, and you have to recognize your share of assets and liabilities on the basis of what is specified in the contract. Because what contract says 100% for A, 100% for B, rather than your 50-50 interest. So if I go to the assets, non-current assets of AB Limited, building 1 will be shown at 240 under PP, building 2 will be shown at 100. Under current assets, cash will be shown at 20. Only thing, in our example, we used to call it JO building. Done? No mistakes, no? What happened? You took 50%. But they said, no, it is full 100%. Anyhow, no problem. Understood, no? That's what, this is the same thing we prepared in the form of a statement. Next, balance sheet of AB, equity, 70, my share. Non-current liabilities, financial liabilities, debt owed to XYZ bank, 240 I will take, and employee benefit obligations, 50. Here, done? Perfect, no? So we'll take one last question on this. Okay, there are some more questions on the journal entry, sale, purchase and all. You can understand it. See, since we have seen that open first example, it's the same logic. So there are some more questions. Maybe as part of the theory we can discuss, I think. Entity A and B establish 50-50 joint operation in a separate legal entity, and that the entity name is called J, and each of the operator has 50% ownership interest and takes 50% of the output. Oh, so even though it's a separate legal entity, since you only enjoy all the output from this, so it is an yeah, who both A and B, 50-50. Otherwise, why they will contribute? Who will enjoy the balance? 50? On formation of the joint operation, they specify and they say joint operator, but don't go with that. Somebody, they may try to confuse you, telling joint operator, joint venturer. Entity A contributes a property whose fair value is 110 lakhs and the intangible assets with the fair value of 10 lakhs. Whereas entity B contributes equipment with a fair value of 120 lakhs. So how much is the total values this joint operation received? So they received 100, 110 plus 10 plus 120. So to total 200, 240. How much is your share? 50%. 120 is your share, correct? Now the carrying amount of the assets contributed by A and B are 100 lakhs and 80 lakhs respectively. So what goes out from your books, like PP, is 100. And what you get is 50% of this 100 plus 50% of other assets also. Like to tell you 2 PP 100, 2 JOPP 50% of this 100. And if you have made a gain, you must have made a gain, no? How much is your gain? 110 plus 10 minus 100. 20 is your gain. But out of that, how much is your real gain? 10 only, to the extent of other parties' share. Now, when this question is going to this, I think this is a new question, no? Study material question. RTP question, not there anywhere. Okay, possibility of this question coming to your exam low, but in examination, they may turn this 50 into 60-40. Then you should understand. Your share is how much now? Suppose if it's 60-40, out of this 20 gain, you have to recognize only to the extent of 40%, to the extent of other parties' share. That is the concept. This becomes a conceptual question because in study material, it doesn't make any difference only. It's a very simple question. But 60-40 comes, then you may get confused. Then you cannot tell alternatively. That is not valued. Assumptions only alternative is valued. Now, what will be the amount of any gain or loss to be recognized by A as well as B in their separate? Okay, what is the B's gain? 40 minus 80, 40. Out of 40, how much they recognize? 20 is going to recognize. So, of other parties' share. Now, if it was 60-40, then 60% of this 40 you would have recognized. Entries and all they didn't, that's what, no. See, the entries they didn't ask here. Entry means that complications would have come. I would just show you for your academic interest how the entries will come. Otherwise, if they would have asked for this journal entry, no, people would have got confused looking at this journal entry without understanding everything in totality. But they just asked how much is the amount to be recognized. So you know that 10 and 20 is the answer. But how to present it? Okay, I'll show you. They have given in 2 ways. Right, as per 111 in the AS 111, when an operator enters into transaction with joint operation, such sale or contribution is actually considered as with other party, not with this joint operation. Because in this joint operation, one party is me only. And this joint operation doesn't have a separate legal structure. I cannot say I have contributed to myself, I have sold to myself. So effectively, when it is a joint operation, whenever you sell something, it is ineffectively selling to other party to the extent of their share. Thus, the joint operator shall recognize gain or loss to the extent of other party share. Entity A and B 50-50 joint operation of separate legal entity. No, because but they said specifically joint operation. They specifically use the word called operation. When they are telling it is an operation, it's an operation. That's what. See, ultimately, you know, you are clear with the concepts. It's just a matter of an assumptions, which you should also telling you very specifically if the question is silent. And I have shown you the assumptions. What assumptions they have taken? SAR and ESOP has been mixed, and they say alternatively if it is as if, how come? Just because you see one word called repricing, you will assume it to be SAR. That is the assumption in study material examination question they have taken. That means this is a small assumption, no? Followed, no? Then your accounting entry will be investment account debit to, your entry will be investment account debit to PP. Again, you will not say joint operation PP account debit to PP. Net assets. From then onwards, you will not say my share of maintenance cost, my share of borrowing cost. You say my share of P&L, one item. They will not ask you like this. That when you do Ind AS 28, then you will understand what type of question they will ask. They will tell you straight away, investment was made. Your operation made so much profit. What is the value of the investment at the end of the year? That's what you need to do. So both the questions are distinct. They see, it's a very rare. They may ask you twist this question into an operation venture. Very rare. So don't bother about it. Followed, no? You have to trust somewhere, someone, whoever tells. And I have spent 6 years. 6 years is a considerable amount of time with these subjects. So somewhere that gives us some feeling, gut feeling from insides. And you have not spent that much time with this subject. Have you spent 6 years? No. So you don't feel that, you naturally feel afraid by looking at this type of thing. What if they do? I'm telling you, I'm showing also, not just telling you. I'm showing you every examination question. Look, this is the way, this pattern they will ask you. This is what they do. But they are unpredictable. I cannot predict at this point of time. If somebody is predicting, okay, that's fine. But they are unpredictable. Because prediction is overall somewhere you can give one guesswork. Oh, this area important. But exactly how a question is going to come, that nobody can predict, no? It can be a simple question with a small twist, which will change your entire answer only. Or it can be one present value factor extra there. It will change your entire answer. So what is the use of that prediction? What is important is understanding the concepts, being energetic, feeling, thinking when you are going to write the examination. See, that feeling should come to you. That feeling, no? Let me write right now. Excitement should come. No, I'm telling you, see, your feeling is the best guide for you. That if that day you get the feeling, no, the more and more strong preparations you do, you start feeling that. Like, see, Neeraj Chopra, he has practiced his throw life. See, he is waiting for one opportunity just to demonstrate who is he. And all those athletes, no, just to feel when my time is going to come, so that I can show to the world who I am. If they are not practiced, that feeling doesn't come. So for that, that's what I'm trying to tell you. You develop that. Let it take time, no problem. See, for me, I'm pursuing from past 6 years. I'm ready add another 10 years to it. I don't have any hurry to become successful, to have so much things. Let it take time. No, we have got entire life. Only pray God that we are alive. We can do anything. We can achieve anything in our life. But when we do, let us get into it, get to the core of it, and we'll demonstrate. Follow? No, I'm just telling for online, so many students, I'm just telling about myself. Okay, you can take some whatever points or whatever you find relevant. Okay, so are you clear about this? Let us do the calculation. So they have given some point that you have to recognize to the extent of your share only. So how much is the gain or loss? Calculation of P&L by entity A. Now, what is A's share of net assets, fair value of assets? It is total 100 plus 110 plus 10 plus 120 into 50%. How much it comes to? 120 minus how much book value of asset contributed? No, 1 minute. Something I missed, I believe. Yes, sorry students. Yeah, again, just we have to remove this 120 because it's not my contribution. No, my contribution is what I shared is 120. Now, how much I contributed book value? 100. So, my book value to PP went 100. Okay, but will I say joint venture PP 120 60? No, out of that my share I should reduce. So what is my profit? 20 is the total profit. So share of profit which I should recognize is 10, which is 50%. If, see, how much asset you give, what is the value of the asset you are going to get the share now? 120 is 50% you are going to get. You call it JOPP. How much went out? 100. Followed, no? But in this 100, when it went out, 100 went out, and you got 120. In 120, there is a profit element. That profit you cannot recognize, no. In this profit, there are two profits. One 10 rupees profit, 10 rupees profit. In this 20, there are two profits. So what you recognize, your PP will be only to the extent of 10. Can you tell me the journal entry? Okay, that is the best thing. So this is what ICA is telling. Let's pass the journal entry. No? Can you tell me the journal entry? B also. But what they asked you? Gain or loss only they asked you. How much gain or loss you will recognize? What will be the amount of gain or loss recognized by entity A and B in the separate financial statement and consolidated? Did they ask you what is the asset they will of B they will recognize? No, not relevant. I will recognize only 10. So what is my journal entry? That is my question. Which PP? JOPP account debit. How much? Sorry? How did you get 70?
Share plus profit 10.
Okay, first of all, we'll write 2 PP. What goes out? 100 goes out. Okay, how much you get your share of the joint PP? 60. Okay, and then you will debit that. Who is that other party? B Limited. How much you need to debit? For the only for the profit? You will share 60. His share is 60, no. You will debit 60. So now it comes to 120. Will you say 2 P&L account? Will you say 20? No, 10. If this has to be 10,
He said maybe 60, not 60.
whose share is 15?
JOPP is not 60.
Exactly. What is JOBP? 50. Exactly. Perfect. Sorry? That's what we have done. We have recognized. No. What I have told here, look, my asset goes out. How much? Full 100%. But same comes back to me. How much? 50% comes back to me. So if I cannot recognize, no. That's why if you see, what goes out into its 50% is exactly what I recognize in a different name. But what goes out, something doesn't come to me, which is nothing but B Limited. But at what value B Limited comes in? With the profit, his share of profit. My book value was 100. I sold him with the profit, and that comes with the 60 rupees. Now, if I have to give you this journal entry, now, confusion, no? Now, are you clear now? After considering the original example, yes, Vishnupriya? Are you clear now with the journal entry? That means what goes out with from you is full PP. Today PP is no more because physically it is not existing with you. It is existing somewhere else. In that your share is 50%, but you cannot recognize a profit in that. In that B's share is 50%, but with the profit, that profit you will recognize. Yes, now we will go to the B, P&L by B. How much And see, they have told alternatively, you could have recognized like this also. ICA is telling alternative answer. Share of 240, how much you took? 120. Total fair value is how much? 110 plus 10 plus 120, correct? In that, your share is 50%. To get this 50%, what you contributed? 100 you contributed. And unrealized portion of the assets, what you transferred? 120. Same thing they have done. Ulta, another like this they have done. Minus this, and your gain is 10. Previous is easy, no? Now let us calculate for the B, P&L of B. B's share of fair value of that asset. How much? 50% of 120. 60. They B contributed something. In that, how much is its share? 50%. What they contributed? Some patent or something, no? Equipment. B contributed equipment worth 120. Its share in that is 50%. Minus book value of asset contributed. How much? 80 into 50%. 40. 20 is your profit. Can we talk about one journal entry? Easy, no? 2 PP 80. JOPP, we'll keep it for time being. But let us keep. A Limited 60. Now my share is 40. 2 P&L 20. And this 20 is nothing but this. Alternatively they have given like this. You say anything is okay. You would have done this way also. But it is the same, no. Same that 20 we are calculating. Okay, journal entries they have not asked, because if you see there is one journal entry they have given, weird type of journal entry. Okay, they have given a journal entry like this. Okay, their journal entry is, in the study material they have given one question. Their journal entry, shall I tell you the journal entry? Study material journal entry. Huh? The study material journal entry for this will be A Limited account debit 60, to PPE 40, to P&L 20. In exam, if at all they ask you, pass this entry, because in study material they have given this entry. What we have done? We have taken JOPP, which doesn't exist in the institute size. Institute says, look, what you have transacted with other party only. Why you are talking about JOPP? That some faculty told you, and why you are writing this? I don't know. So institute wants you to write, recognize A Limited full. What PP goes out is his share only, not your share. Your share is retained with you only. And recognize the PP. Are you follow? Did you clear? Yes, students. That's it. Alternative way of doing. Thank you. Done.